Howdy, Jacob here. Today we're going to do a more in-depth analysis on Alpha Metallurgical Resources. We just did this company, we just reviewed the company, and it looked to be a deal with my initial assumptions. So this video is going to go into more in-depth after I've reviewed the quarterly reports, the most recent 10K and couple 10Qs. I took some notes. And so just remember everything I say will be my opinion. Do what you want with it. This isn't meant to be an end-all be-all in-depth review. Beyond this, if it still looks like a good deal, you would still need to look at all of their competitors and see whether all of your assumptions hold with comparing to competitors. Do they have some sort of advantage? And will they keep longevity? Since obviously when you invest in something, you're not expecting it to go up the next day, the next year. This is hopefully going to be a long-term investment for you. And so please understand that. First, I'm going to review the numbers, and then I'm going to go into some of the notes that I took from most recent quarterly reports and 10K. So to remind ourselves, it is in the metals and mining industry. They are in the metallurgical coal industry, meaning that almost 100%. And just recently, they removed all their thermal energy to where their met coal is pretty much 100% of their revenue. And so 2.6 billion in market cap, 2.2 billion in enterprise value. Their net debt, it looks good. 268 million cash on hand, 4 million short-term debt, 7 million long-term debt. And those are financing their equipment. And growth of revenue has been kind of all over the place. With the last 21 and 22, growth was crazy, and it's actually down a little bit. So there's likely going to be dampened demand from what I've seen and from expectations. But over the long run, we still see compound annual growth rate of coal, especially metallurgical coal. They've paid a dividend recently, but majority of their capital allocation is share repurchases. You can see 522 million, 540 million, 357 million of the last 2 years and rolling 12. So let's look at some of the things I pulled from reports. So AMR is the 11th largest coal producer in the USA by total production with 2.7% share, based on a 2022 study of U.S. Energy Information Administration. So again, this is 2 years ago, so it's a little bit aged, and their dominance in the market is actually kind of low on a total coal basis, but you'll see that they actually do have about 20%. I think I wrote that somewhere, of the market for right here. So met coal has about 72.4 million tons produced in the US. AMR is 20%. So the difference between metallurgical coal and thermal coal is that metallurgical coal has a higher price point because it's used for, I don't know if I'm saying it right, coking for steel. And so there's a premium that comes with that type of coal product. And they've recently reduced all their thermal coal to almost nothing, to where met coal is going to be essentially all of their mining. So share buyback has 0.4 billion left. 0.4 billion in relation to their market cap is about 16% of outstanding shares. So hopefully soon they increase that share buyback capability. As of 23 Q3, Met represents nearly 100% of volume and revenue. Again, that's saying they got rid of their thermal mining, and so almost everything is coming from Met. Their total long-term debt and current portion of debt is 8.6 million. Nothing in relation to their over $1 billion production of free cash flow. Again, this is just going to be equipment for them, so we're not concerned with their debt whatsoever. Metallurgical coal global market is expected to grow at 2.9% compound annual growth rate into 2028 per Research and Markets. And then from 2001 to 2023, metallurgical coal sold at an average premium of 90% to the price of thermal coal. So again, I'm going to do a Arch resource. I'm going to post that just after this. And what you'll see is that Arch has a lot more tons of coal being produced on thermal rather than metallurgical. So that's going to be the biggest difference between Alpha Metallurgical and Arch Resources, is that metallurgical AMR is almost entirely based of or comprised of met coal, whereas Arch is much larger on a tons basis, but does not produce quite as much meta in relation to their thermal coal. So again, that's something you're going to have to do more research on. I can't explain everything. I'm not an expert in coal, so this was very interesting read for me to understand more about it. But at the end of the Arch video, I'll also go into which one I like better. So they used about 5% of tons in 2023 compared to estimated reserves. Their estimated lifespan of all combined is roughly 15 years. So what that means is that they have a huge amount of capability to still take away coal. And so for me, based on this 7-year analysis, I feel very comfortable with my analysis based off the numbers, because almost all of their reserves have 5 to 20 years ahead of them in lifespan. So again, still not concerned about that, the reserves being taken out in the period of time that I'm looking at this business. I already said this. Alpha Metallurgical is 20% of the met coal market, even though they're 11th in the total production of coal producers. Their coal foreign export revenues account for 74%. So we know that, or I know that the coal expectation and demand in the United States is actually down over the last 50 years since we've become a lot more technologically advanced. There's been less coking or coking for steel products. However, in India and China and Australia, this is a huge demand still. So that's why globally the market is still expected to grow at 2.9%. And that's why their foreign export rate is still as high as it is. Their largest customer accounted for roughly 13% of total revenue, and their top 10 account for 74% of total revenue. So that's a lot. That's one customer making up 13% of their revenue. That could be a huge hit, and that means that that customer has a lot of demand and a lot of power when it comes to making decisions. And when you renew on prices and everything, that customer is going to have a lot of power. And even their top 10 being 74% of revenue, that's a lot. So they're pretty centralized with their where their demand is coming from. But again, you're just gonna have to think about that for margin of safety for yourself. Coal Resources are 27% owned, 73% leased. This is quite a bit different than Arch, which we'll see shortly. And I hope you watch that one and enjoy that video as well, because they're pretty similar companies. So I think it's good to look at competitors to see which one you like more. And someone like Peter Lynch used to actually buy multiple businesses in the same industry, and then after he'd understand the businesses a little better, would maybe dampen or entirely remove some businesses from his investment portfolio and keep the ones that he understood best and had the best probability of growth. So now we're getting to capital allocation. About 2% is to acquisitions, 29% to debt paydown, 6% to a dividend, 53% to share repurchases. So they did pay a dividend that actually has been removed recently, and so they might still give an annual dividend at the end of the year, but I'm not going to guarantee them because they don't have a quarterly dividend that they pay out or semi-annually dividend that they pay out. So I'm removing that, making it go to zero. Again, they might pay a dividend at the end of the year on an annual basis, but it's not currently set. So I'm not going to assume it. That's part of my conservative estimate. A lot of money is going towards share repurchases. So again, I'm going to assume that a lot of money keeps going to share repurchases. 4% for them is about $100 million. To offset stock-based compensation, about 120. We're not concerned about that. That's a very, very, conservative in my perspective. Even given over here, the average of free cash flow was still a good amount, and so I'm not concerned about that share repurchase rate. And then they don't have debt anymore. They have 8 million, so essentially nothing. So that 29% to debt that they've done in the past 3 years is going to go to somewhere else. And so I'm going to assume a little bit to acquisitions, a little bit to reinvestment, and then a little bit to share repurchases. So that's why we're assuming 4% on the share repurchase side, 3% on the revenue growth side, minimize the margins slightly, and then a 17.5% return based on the fact that their one client makes up 13%. and we're saying it's still a buy price. So to me, that means I'm going to have to do more research on this company beyond this in-depth analysis, meaning that I'm going to have to look through their competitors' 10K and everything like that. But I hope you enjoyed the video and have a great rest of your day. Thank you.